There are two prices for silver right now, not two opinions, not two forecasts, two actual prices, two completely different realities separated by an ocean and a wall of lies. In New York, the ticker says $32.47. In Shanghai, the same ounce of silver is trading at the equivalent of $95. And no, that is not a typo. That is not a currency conversion error. That is a $63 gap on the same metal, on the same planet, on the same trading day. For years, we have been told that markets are efficient. We have been told that arbitrage closes every gap. We have been told that if something is cheaper in one place, traders will instantly buy it there and sell it where it's expensive until the prices converge. That is literally day one of any economics textbook. So why hasn't it happened? Why is China paying nearly 3 times what Americans pay for the exact same asset? The answer is going to make you uncomfortable. It is going to challenge everything you think you know about free markets, about price discovery, and about who really controls the value of your money. Ladies and gentlemen, welcome to Quick Reveal Docs. And by the end of this video, you will understand exactly what the market is confessing. Let's get into it. Pull up 2 screens right now if you can. On one screen, load the COMEX silver spot price. On the other, load the Shanghai Gold Exchange silver contract, the AG9999. As of this morning, COMEX shows silver at $32.47 per ounce. The Shanghai Exchange shows 7,892 yuan per kilogram. Now, let me do the conversion for you because this is where the magic trick happens. 1 kilogram is 32.15 ounces. The current exchange rate is 7.24 yuan to the dollar. So 7,892 divided by 7.24 gives us $1,090 per kilogram. Divide that by 32.15 ounces and we get 33.91 per ounce. Wait, that is only a $1.44 premium. That doesn't sound like a crisis. But here's what they don't tell you. That is the paper price. That is the futures contract price. That is not what Chinese industrial buyers are actually paying to get physical silver delivered to their factories. The physical delivery premium in Shanghai has exploded to between 55% and 200%, depending on the quantity, the purity, and the urgency. And I can promise you, the Chinese are not stupid. To understand the $63 gap, you first need to understand what price actually means in different markets. In New York, on the COMEX, the silver price is determined by futures contracts. These are pieces of paper that represent a promise to deliver silver at some point in the future. The key word is promise. Most of these contracts never result in physical delivery. Over 95% of them are settled in cash. Traders bet on the direction of the price, collect their profits or losses in dollars, and never touch an ounce of metal. This is called the paper market. And because it is dominated by financial players, not industrial users, the price reflects financial sentiment, not physical reality. Now let's look at Shanghai. The Shanghai Gold Exchange operates differently. Yes, they have futures contracts, but the exchange has a much higher rate of physical delivery. Chinese industrial buyers use the exchange to actually acquire metal for manufacturing. They're making solar panels, they're making electronics, they're making batteries and medical equipment. They need the silver. They cannot settle for a cash equivalent because you cannot build a smartphone with a wire transfer. So when these industrial buyers show up and say, I need 10,000 ounces delivered to my factory in Shenzhen by Friday, they are not playing a financial game, they're placing a real order for a real commodity. And what happens when real demand meets real supply constraints? The price goes up, not the paper price, the real price. The price you actually pay to get the metal in your hands.